just list off some of the questions. It's going to be a short video. List off some of the questions that I see here and then address them. I'm not planning. I didn't do any research. This is just from my experience, my point of view from being a CFO and a CPA, for over some years now. So first one, how do you determine whether a company is over leveraged or under leveraged? So I'm looking at that balance sheet. A lot of CPAs don't know how to read that balance sheet. If you're over leveraged, there's a lot of debt that you have on your books. It's just too much. Where it's the point where it's like, man, I feels like my business is living paycheck to paycheck just to pay debt. Those usually the feelings you get are those usually things business owners say where you're just over leveraged, right? You have so much debt on your books where you don't really need it. And when you're under leveraged, it's just the opposite. You don't have any capital to go make some business decisions or business moves out there. So you're under leveraged, you have no leverage. You need to put yourself in a position. Usually that comes from building up your operational cash flow to basically go make some money, be bankable, get some good debt to go build and grow more. This is a common case of this is when restaurants do so well, they're really trendy, they're doing great. They basically take that cash and basically go get a loan to open up another location in the other area where they plan to grow their capital. All right. So just giving you an example of what that looks like when it comes to our business. I hope that helps. When does bringing in investors strengthen the business, and when does it weaken control? I could tell you when it's weaken control now. I got a client right now. They're a private equity firm. He didn't have any rules about his investors. There's no minimum. Basically, anybody can just come in. That killed some of his processes. And it was a sloppy way to raise capital. So having controls under what type of investors you want, what's the minimum, the rulings behind your JV agreements, all that matters, because if it's not on point and you're letting too many animals in the farm, it's hard to maintain that zoo, right? So once again, if you're letting too many different animals in, it's too chaotic to control that zoo. There has to be a set structure and a good SOP, standing operating procedures on your investors, on how you're bringing them in. What does your investors look like? What are their minimum and what's the terms, right? So, bringing in investors does strengthen the business because they're going to help inject equity into that company. A lot of businesses, if you think about it, they're always, you got to pull capital in somewhere. Usually it's from an investor that wants a profit sharing payback, or it's through you just having your own set of capital. But if you really want to invest in something big and kind of grow, usually you hear investors giving money, sending you money, right? So people should set up profit sharing agreements where it's like, hey, we're getting a share of the profits each month. That's something that I've seen, or people just do capital raising where they're basically just getting a pool of money and then they're buying other companies, my private equity or investment firms there. But more of the story, if you don't have any guide rails or railing on how you want to basically control your investors, it can basically lead to chaos and angry investors too as well. So that's very important. Next question. What financial signals indicate a company is ready for institutional capital? When they have a great set system. Usually when you're going to go get capital, depending on the size of it, you need to get audited. You need an internal review. The bankers are going to want to see some type of report saying the truth over your numbers by independent accounting firm. Depending on the size, sometimes you're going to go get capital. But more of the story, you're going to have your financials clean, because banks are looking at that bottom line and say, hey, is this company able to pay their loan or their line of credit back? So they're looking at that profitability and they're looking at your cash flow. So it's very important that you set up some people take years, 1 or 2 years, just to set up their financials in a place where they can basically go get money for the bank. Very important. Some people don't really take interest, and it's usually those companies that's with the most 1 million to 3 million range, where like they know what they're doing, they're producing money now. This is their first good year in business, but now it's time for them to scale and grow. That means sometimes we need debt, good debt, to go do that. So one of the things that stops us, especially if you're looking to acquire another company in a different location or wherever, one of the things that stops them, or a major roadblock, is their financials. It's not ready, it's not accurate. They got mom and pop bookkeeper, didn't know what they were doing. They have inventory, but the inventory is not tracked. You can't go to the bank like this. They're gonna look at you like, we need to go fix that. Now it's delaying. I had a tire company that's looking to grow and scale all over Texas. One of the things that stopped them was their ability to go get capital, just because they didn't have their financials. Now it stops them. Bank says, hey, y'all guys aren't making a lot of money. All right, so that's something that you need to look at for when you're ready to go get some banking capital. What mistakes do business owners make when negotiating financial terms? I know when that question came in. Yeah. So I answered this question before. They aren't looking at the terms. They're getting expensive money. So usually when you're going to go get debt, you don't want that money to be expensive. You'll be paying back high interest, especially if it's weekly paybacks or those MCAs. You never truly want to get those. I've seen those kill too many businesses more than help them. I know there's times and place for everything, but you're looking at the interest paybacks, and then also the frequency of when you need to pay back. I'm a big fan of line of credit, sitting on those and using those for special occasions, for when you need to take advantage of a certain opportunity, because it's going to help you grow, scale, and make more money. So those are things that I'm looking at. How can automations improve transparency when preparing for lenders or investors? Automation and software. Once again, I got another story. I was working with another private equity firm. They were handling their email and investor relations with all investors through email and phone calls. I was like, Jesus, excuse my language. We're saying the same thing over and over again. I need a system or a platform where I get to basically communicate everything to every investor, so I don't burn out from talking to all the investors. So there's a platform, InvestNet, Syndication Pro. There's a Jupiter. These are platforms where all your investors have one portal, because your investors are going to need their K1s or either their 1099 interests. So their tax documents can be in that portal. You can communicate and do your monthly reports, financial reports, and do your Loom recording in that and send that over to that platform where everyone can basically review that update. These are things that's needed from when you're controlling that zoo, is what I like to call it. You need a platform and you need automations where it's put in place to kind of streamline the redundancy. You want to streamline that redundancy because it gets you out of the weed of maintaining that zoo and actually helping it grow. What I mean by that is, like, we're not just doing maintenance 24/7. We have the automations to help us do the maintenance. We're more creating strategic impact for the investors to let them know that their investments are either doing good or bad. That means I'm doing more Zoom calls and doing more speaking, because at the end of the day, as their CPA or the CPA or CFO that acts as their investor relations to as well, they mainly want me in there to say, hey, is this money that I poured into giving me a good return or not? How's the forecast looking? What does 2026 look like? These are all questions that they have. These are questions that I need to be prepared to basically answer for them. So these are things that, these automations and software are things that help me get out of the weeds of maintaining that zoo and really helping it grow, really pouring more knowledge into it so they can, bottom line, know about their investments. Great question, by the way, whoever put that in there. Amazing question. Because most don't do that. Most are still stuck in the old school way of doing business. Hey, let's email. That means you're sending off 40 different emails with the same thing, copy and pasting it down there. What role does a financial forecasting technology play? Oh, I think you spelled that wrong. What role does financial forecasting technology play in capital planning today? I love it, because all our CFO clients, they get a forecast. This lets them know where the gray areas may be after the year. If you're let's say a doctor or a lawyer, and we know, like, you're here in Houston and maybe the rainy seasons are sometime in the summer. Usually when it rains, my personal injury attorneys make more money because there's more crashes, right? Or usually when we have, like, for example, we have the rodeo here, we have there's a feed for soccer. A lot of stuff is happening in Houston. That means more people are traveling to Houston. That means there are probably going to be more accidents on the road. So we're forecasting all those assumptions based on 2026, about slight percentage increase in sales. We're targeting that because these events can help, these like special circumstances can help increase a attorney's revenue. People don't look at it like that. When a snowstorm comes in, our private adjusters, our roofers, we're factoring that into the 2026 forecast. All right. So there's a lot of things that tie into the financial forecast, and we want to be able to map what the year looks like. Surprises. There may be a time where I'm using the attorneys again. It's probably slow during, let's say, they're never really slow to be honest, but it's probably slow for in the summertime. Just make it up a day. Now we need to game plan how much capital they need to have on hand to keep their expenses going. We know that salary is this much, salary is that much. Hey, don't hire during that month. We want to explain that, right? So that's real beneficial for our business owners to kind of see what 2026 or 2027 looks like, especially if they're doing maybe like a big acquisition where they're buying another company and they want to forecast their information inside of the forecast for them to see what does buying that company look like for this company here. All right, so these are good things that's happening. That's good. That's a good question. Yeah, and the question here: how does cash flow cycles influence capital strategies decisions? I kind of already spoke on that a little bit, so I'm hope that answers your question. Here's a smaller question in here: what do I need to get for my taxes? Okay, let me address that one. It's a non-advisory one, but I'll address that. Your taxes. Assume that you're a business owner. It's real simple too. General information of the business, EIN, LLC. That usually take care of it. Then you need your financial statements. That's where some of my smaller entities, they are. For some reason, people aren't having their financials. You'll be surprised too. They can be a big company. They can be a well-established company, 10 years, making around 2-3 million, still don't have accurate financials. I'm always shocked. You need to be best friends with your CFO. Right? You need to have a CFO on your board, even if it's fractional. They need to at least meet quarterly at minimum to help you guide your way through your business. That's what a CFO is doing. But to answer your question, that's what you need: the general information in the financial statements. On your financial statements, the profit and loss shows us how much money you made, your expenses, and your profits. That usually gauges your tax liability. And then on that balance sheet side, make sure that's right, because we have loan interest. I want to make sure the loans, I want to make sure that it shows up on the profit and loss. So if you got debt, I'm pretty sure you got interest expense. Want to make sure that's translated properly on the profit and loss. You got assets that you have. I want to make sure your assets, we get to take advantage of that on your tax return. So I want to see that depreciation rolling over to that profit and loss. Don't take for granted that balance sheet. It's not scary. It's not scary. All right, it's not scary. Assets equals liabilities plus equity. It's real simple. All right, you want a list of your assets, list of your liabilities, and list of your equity. All play a pivotal part, and they all play an important part in the role on your tax return. From your assets, liabilities, your equity, it plays an important part on your return. Great question. But guys, with that, I'm going to cut it short. This is just quick Q&As. If you have any questions, please put them in the channel. We collect them from YouTube, Instagram, client emails, and this is where we to compile them, put them in a channel like this right here, where I'm just firing off these questions. It's a good way for me to basically take somebody's questions, maybe just give everyone the rundown on how I'm addressing it. Thank you so much, and have a good day, guys. My name is Christian Eyman. I'm also author, Breaking the IRS Press. Please go get your copy, guys. In this page, there's one page. If you don't read the book, I want you to go to one page. It's a page that talks about AI. The IRS is always stepping up their game, right? They're always stepping up your game. You can use AI to help you navigate a little bit through the IRS system, where you will know what to do or what letters to kind of draft to help you send to the IRS. Granted, if there's a lot of stuff going on with your IRS case, always reach out to a professional. This book isn't meant to replace your IRS tax resolution specialist. It's meant to give people that have smaller IRS issues, like a first-time penalty abatement. It's meant to basically give you a rundown on how to tackle that, because you may not have the funds to basically address the IRS issue or hire someone like some of my friends that handle IRS tax resolution, myself, or like a CPA, right, or attorney. You may not have the funds to. So this book helps you and gives you a guide on how to basically solve those issues. It's not meant to run front through back. It's meant to pick your issue and say, I'm dealing with this. Let me go here. And it gives you a rundown of the importance of finances too as well. Great book, guys. Please go get your copy, Breaking the IRS Press. I'm an author, a CPA, and also CFO of many businesses. Thank you.